Welcome back, you legends. I'm Dr. Khan. This is going to be a great video because I have a lot to talk about. So let's get right into it. So this is the stock market map for today. And yet again, we're seeing big cap tech, Microsoft, Apple, Google, and Amazon leading the pack. We had a beautiful rally today in the NASDAQ, up 1%, while the S&P had a mediocre rally of a half a percentage point, and the Dow Jones was flat. If we take a look at the different indices, clearly we had communication services, cyclicals, financials, tech. So the risk on sectors leading today in response to a slightly cooler than expected inflation report. So we had the year-on-year CPI came in at 4.9%, 0.1% below consensus, and then we had the core rate come at 5.5% in line with the consensus and 0.1% below the previous reading of last month. Tomorrow, guys, we'll have PPI, and I expect PPI to be actually considerably lower than CPI because we had all of that suppression of commodity prices after the banks, the regional banks failed or began failing about a month and a half ago. If we take a look at the weekly chart again, cyclicals, tech, basic materials, all leading the market with energy, financials lagging. That's again an indication that yes, the market is now trading inflation cooling down and is buying into growth companies. Let's take a look at the daily chart for the S&P 500. Again, we have this very peculiar looking bull pennant or bull flag, right? We have this flagpole, then we had this expansion of volatility, then we're seeing now a contraction of volatility. So it looks like a diamond pattern that is forming. If we get a break above, we'll get a continuation to the upside up to 425, between 422 and 425 on the SPY. If we get a break below, we will likely move back down to fill the gaps. Now, according to everything I'm seeing on the charts, the technicals, they indicate that we will likely see a continuation to the upside first before we move back down. So really the same picture that I talked about in my last video before the CPI came out. The CPI only served as confirmation to the bullish side in the short term. Now, this is not the most interesting chart. The S&P is not the most interesting chart. The most interesting chart that is showing signs of a blow-off top, a melt-up coming up, is the NASDAQ. This is the NASDAQ and it's forming a very well-defined volatility contraction pattern. If this is the first time you're hearing about the volatility contraction pattern, it's a very high risk-reward setup. In fact, most, if not all, US champion traders rely on this exact pattern to generate outside returns. This is the exact pattern, guys. We have an expansion of volatility rising to the upside, momentum pushing up. Then we have smaller and smaller waves forming what looks like a prolonged bull flag with a slightly higher lows. Then we get a breakout after the last low and a massive melt to the upside. Overall, this is what I shared in the trading community today. Despite the extremely negative sentiment in the market and the bleak fundamental picture for the economy in the second half of the year, price action remains king, and this VCP volatility contraction pattern indicates a surprise to the upside is in the cards. Again, guys, that speaks to the 332 target on the NASDAQ that I talked about in my fractal analysis that I discussed in the last video. Please, guys, stick around. This is going to be a really good video. I have a lot of stuff to talk about. So this is the fractal pattern that I talked about, where we had a large wave to the upside, then contraction of volatility, each wave smaller than the other. In fact, I calculated the contraction volatility and it was about 40% down in every wave. That is volatility is contracting by 40% each wave to the upside. And in fact, I even calculated the angle of each contraction, and it's been declining significantly. We had a break above resistance earlier in the week on Monday. Again, we had another break today, and we will likely continue to see a melt up in tech to hit that full measured move measured from this double bottom, right? If you calculate the distance from the bottom to the neckline, then you multiply that by 2, you get the full measured move, the calculated objective target, and it's at 332.5. And I expect the NASDAQ 100 to hit that target as this volatility contraction pattern with higher lows every single time pushes to the upside to continue this rally and realize the full measured move. The NASDAQ daily chart, guys, continues to look significantly more bullish than the S&P, right? We have a bullish cross on the PPO today. We had another buy signal on the smart money flow indicator. By the way, guys, this is a free indicator to every member in the community. And we had a buy signal on a Monday. We had a confirmation of that buy signal by the PPO today. Again, notice this volatility contraction pattern, guys. Does it not look identical to the textbook definition of volatility contraction? We have a low right here, a higher low, another higher low, and another higher low with volatility contracting, i.e. smaller and smaller candles, smaller and smaller moves until we get a break, and that happened today. It looks identical, guys, right? Higher low, another higher low, another higher low, waves smaller and smaller. Then we get a break. You put a stop below the last low, and then you ride the last wave to the upside. And usually, guys, this is an explosive move to the upside, and I expect that this explosive move will push the NASDAQ 100 to that full measured move and probably give us the final high in the NASDAQ for May and potentially for the entire year. This target also makes sense because we have this unfilled gap from the August highs, and we have big tech companies like Microsoft and like Apple taking out the August highs. We're now beginning to see other tech companies like Google and Amazon, etc., beginning to participate in this rally to the upside, and that will allow the NASDAQ to realize this full measured move. Going back to the S&P 500 daily chart, guys, again, we're seeing the PPO contracting here, getting very close to a bullish cross. However, the S&P 500 has been dragged down by weakness in the Dow Jones. Really, tech has been leading this rally to the upside and has continued to lead, while industrials and old style economy companies like energy, etc., have gotten crushed as credit has been tightening and as commodity prices have been seeing pressure to the downside recently. That's why so far, guys, we've mostly been seeing only a handful of stocks, about 8 to 10 stocks, providing 80% of the positive return in the S&P 500, and all those stocks are tech stocks. And some of those stocks have already begun putting in major tops. Some of those stocks are still participating in the rally, and they will top as the NASDAQ hits that target in the next little while. Let's take a look at some momentum indicator. Down below, guys, is the BPSPX, and we're getting a bullish cross here coming in very soon on the SPY. The PPO is also about to produce a bullish crossover, although likely, guys, the S&P will continue to be dragged down by that weakness in the Dow Jones and the industrial components, as well as financials and energy stocks. Other momentum indicators like the advanced decline line have hit extremes twice, putting in a double bottom, and we are now smack in the middle of the range. Likely, guys, the NASDAQ will continue up while the S&P 500 will continue to drag its feet, participating, but only meagerly, honestly. Now we're getting into really interesting stuff here, guys. This is the HYG, the smart money is up top, the dumb money is down below. We had a bit of a contraction here, smaller and smaller candles, not really decisive. However, the PPO is beginning to potentially curl back over here, suggesting that risk appetite is beginning to flow back into the market, again, led by big cap tech. If we take a look at another risk appetite indicator, this is the XLY, consumer discretionary divided by XLP, consumer staples. This measures the health of the American consumer. And what do you notice? We had a slight pushback up on the PPO histogram this week. We failed to produce a bearish cross, and that indicates that risk appetite is back in the market. Notice this recent breakout led by Tesla, Amazon, and the rest of XLY components. We need to close above the 50-day moving average for a continuation to the upside. I think that will eventually happen. as the NASDAQ continues to grind its way up to that 332 target. If we take a look at the Dow theory model, up top is the Dow Industrials, down below is the Dow Transports. We're getting a bit of a mixed signal here. We had a bullish divergence back here on May 4th that resulted in this upside move in the S&P 500. This is the S&P 500 down below here, guys. We had a bullish divergence here. The Dow Transports put in a higher low as the Industrials put in a lower low. That resulted to the upside move here. We need to start seeing the transports continue to lead to the upside to allow the S&P and the NASDAQ to continue to rally. So far, we're getting a bearish divergence. So we need to see in the next couple of days, preferably by tomorrow on PPI, we need to see a breakout in the Dow Transports to continue to see this melt up move towards that blow off top that is now coming in very soon in the NASDAQ. Another risk appetite indicator, this is the value line index. Up top, down below is the S&P 500. And I talked a lot about this significant negative divergence between the two. And I said that I expect this negative divergence to continue as the S&P likely takes out all of these highs, goes back to 430 by about late summer, perhaps in August, late July, something like that, right? So 422 will come back down, fill the gaps, move higher, take out all of these highs, put in the final top for the year. And that's when I expect the divergence to complete, where we have higher high on the daily chart for the S&P 500. And a continuation of the bearish divergence between the value line index and the S&P 500, putting in the final high for the year. Similar, very similar to what we had back here, guys, in late 2021, a lower high on the value line index corresponding with the final top, the all-time high in the S&P 500, and the beginning of a new bear market phase that will likely begin in Q3 and Q4 of this year. And now if we take a look at another risk indicator, this is the housing index up top. This is the S&P 500. And what do you notice, guys? We had a higher high on the housing index while the S&P 500 has struggled to make higher highs. This tends to be a leading indicator, so I do expect the S&P 500 to eventually take out all these highs, break out to the upside, put in that 422 high, come back down, then put in that final melt up high at 430 on the S&P, on the SPY, and put in the high for the year. The PPO is beginning to curl back down, indicating that the S&P will likely put in a local top here soon. Again, 422 is my objective target for this high in May. Up top, guys, is the copper to gold ratio. Down below is the S&P 500. Again, another major bearish divergence developing here. Again, similar to that massive bearish divergence that indicated that the high was in back here in late 2021. Massive bearish divergence as the S&P was making its final high, the all-time high at 480. The copper to gold ratio was making lower highs. We're beginning to see somewhat of a similar structure here, a prolonged negative divergence that will eventually lead to the final top in the S&P 500. Again, I expect that to come around the late summer period, late July, early August. And I expect September and October to be extremely negative for the S&P 500 in the overall market. This is the imminent doom indicator. It's TLT divided by SPY, and the signal that I'm waiting for is a cross above the 5-month moving average. These crosses have signaled the final top before a major recession-led crash. We haven't yet gotten there. We do have a bullish cross on the PPO, so we will likely within 6 months get that sell signal. I expect that sell signal to come in late 2023 this year, corresponding with the beginning of the recession, and a cross above where TLT finally begins to break out, outperforming the S&P while the S&P 500 continues to crash, forming a continuation pattern for the bear flag structure that began forming as early as January of last year. Meme stocks up top, S&P 500 down below. Meme stocks are about to produce a bullish cross. We had a bottom that I talked about in my last video. Meme stocks are rallying now. This usually happens towards the end of the rally when we get the melt up blow off top phase. We usually get meme stocks participating. We had Carvana rallying. We had weed stocks rallying. We had a lot of stocks rally. In fact, guys, I shared over a dozen different bullish setups and some bearish setups in the trading community. that are beginning to materialize right now. In addition to my live analysis, guys, I do share trade setups pretty much every single week, sometimes a dozen plus a week. And this week has been particularly good for these setups. Most of them are actually bullish despite all of the negativity that you've been hearing recently. A lot of stocks not realizing their full measured moves yet. They're still moving to the upside. They're about to break out, producing outsized risk to reward setups. If you want to keep up to date with all of my setups, all of my live analysis, and if you want to support this channel, you can sign up to join our trading community through Patreon. I introduced a 16% discount on the annual membership. That means you get 2 months for free if you go for the annual membership. By the way, guys, 16% is the steepest discount that I could offer on Patreon. I tried to offer a larger discount. It would not allow me. Ghost Legends get to see all of my work, all of my trade setups, all of my live analysis, the watch list, the weekly expected moves, all that good stuff. Living Legends get the premium membership where you get to interact with all of the members, ask questions, and make chart requests. Ghost Legends can only observe, but they cannot interact with anybody. So that's the difference between the two memberships. And there's also a lifetime membership. The lifetime membership is equivalent to the cost of an annual Living Legend membership. So basically, guys, if you pay upfront for a year, you get a lifetime access to all of my work, including all of my charts and indicators like the smart money flow indicator that I discussed before on this channel. If you want to sign up, you can check out the link in the description below. If you want to support this channel, this is the best way you can do it. Now, if we take a look at the NASDAQ relative to the S&P 500, we did have this breakout in this relative performance ratio, and we're getting very close to matching the prior high from March. We have a bullish cross back here in early May, and that again, why personally I was leaning bullish, while most of the retail trading community that I've seen on YouTube was leaning bearish. We did have some subtle hints that the market was trying to push a little bit higher here in May before that idiom sell in May and go away really takes effect, and we haven't quite seen those bullish targets met just yet, and we haven't seen those bearish indicators pop up to begin the selling that we're waiting for. That hasn't happened yet. In fact, guys, if we take a look at the AAII Bull Bear survey, you will notice that the vast majority of retail traders have actually been bearish. Look at this, 45%, significantly higher than all the prior weeks. And so we had a bearish bias going into May that did not unfortunately materialize because, as you know, the market is evil and tries to punish the most amount of traders possible. And so when traders lean mostly to one direction, the market does not like to go into that direction. And that's sort of what we've seen in May. A lot of people calling for sell in May and go away. Unfortunately, that did not happen, mostly because a lot of retail traders have been overly bearish, while we had a lot of bullish setups that haven't yet realized their full targets. Now let's jump to the VIX, guys. It's an important chart to talk about. I put out a note just yesterday in the trading community. I talked about this level at 16.5. I said that we will likely see a push to the upside, tag this level, find support at this level. And that's pretty much what happened. Although notice, guys, the VIX has actually been leaning more bearish than bullish. And that's one of the hints that I was seeing that really told me the market wasn't ready to sell off just yet, because I saw the same exact pattern back here. Notice a high, a higher high, then we had a bearish cross before really we had that massive sell-off, then we had a high, higher high, and we've seen momentum dying out, and I expect that momentum to continue to die out in volatility as the NASDAQ realizes that full measured move before we move back higher, see a breakout in the VIX and get that sell-off that takes the S&P down to 395. Not quite there yet, guys. Timing is really important. It's been really tough timing the market in May so far. This is the one-day VIX. Not a lot going on here, except I'm noticing that volatility, again, momentum for volatility is dying down for the one-day VIX, and that usually happens, guys, believe it or not, around bottoms, right? Around bottoms. That does not necessarily mean that this is a bottom in the S&P 500, but it does indicate that volatility, if it continues to go down, which is likely to continue to happen here as we get a lot of these risk events like the PPI out of the way, like the CPI out of the way, all those earnings reports out of the way, you will see volatility priced out of the market. And when volatility cools down, the S&P likes to truck along and grind up as it puts its final high. I still see more upside left in the S&P before we get a top in May. TLT, long-term treasuries, we had a bounce off this level of support in TLT, mostly because CPI was seen as cool, and the bond market usually, guys, gives us the accurate read on CPI. And so when we had bonds rallying, we saw yields coming down. That indicates that the market is seeing CPI as cool enough to allow the market, to allow the Fed to pause and not raise rates in the next meeting. As long as that continues to happen, the market will continue to have a bullish bias going forward. If we take a look at gold, gold is really struggling to find momentum here. It is chopping around in the middle of this regression upside channel. Buy targets would be the bottom of this channel, and that would correspond most likely with the 50-day moving average, and the bottom of this range that would be around 182 for gold. Not quite there yet. Not a lot of edge on gold just yet at this level. It is still in watch and wait mode. US 10-year yields, again, rejected the 50-day moving average, got crushed on the CPI report. That is positive for tech. As long as the 10-year yield continues to go down, tech will like it and tech will continue to rally. If we take a look at Tesla, it is forming this bull flag pattern. It rallied, then it pulled back to the 20-day and the 5-day moving averages. It is consolidating. This bull flag, guys, has a target of, let's see, 185 to the upside. That would allow Tesla to fill the gap at 184 back here. If we take a look at Apple, still flagging here, not a lot going on in Apple, very slow to move here. It is grinding up to form a top, not quite there yet, but it's coming very close. If we take a look at Microsoft, again, I expect it to realize a target of 315 to hit these prior highs before it puts in the final high here. Momentum is dying down, so we're probably going to get a top in Microsoft soon-ish here. If we take a look at AMD, massive rejection, tombstone style candle. These have marked prior tops in AMD. It had this massive rally post earnings on a report that it was collaborating with Microsoft on a new AI chip. Now, Microsoft has actually denied this rumor, but that doesn't matter, guys. Manipulation works, and this is a prime proof that manipulation works, because even though Microsoft denied it, AMD continued to rally. AMD is likely now hammering out a top, likely to come in to match these prior highs, forming negative divergence, as again we get that melt up move to the upside that gives us that final top in the NASDAQ for the month of May. Semiconductors, again, AMD is part of the semiconductor index, and I'm expecting a head and shoulders top. Still not quite there yet. I expect the SMH to realize its full measured move to hit the upper edge of this Bollinger Band, create an equal shoulder to the left shoulder before it breaks this support and moves back down. That will likely come as the NASDAQ hits that 332 target. If we take a look at the NYA summation index, the New York Stock Exchange summation index, still negative. So it's been trucking along, forming this bull flag pattern. The oscillator has been improving. We're still not yet at a bullish territory just yet. However, the NASDAQ has produced a bullish cross on the summation index a few days ago. Notice this high, equal high, equal high, equal high. Couple of breakouts recently. Again, beautiful volatility contraction pattern, making higher lows contracting, ready to really make that melt up move, that blow off top that I expect to come very soon here to put in that final high for May and potentially June, that 332 on the QQQ. Unfortunately, 50-day breadth for the S&P 500 continues to trend down, making lower and lower highs. 200-day breadth again continues to trend down, making lower and lower highs. Why is that? Well, again, guys, because only 8 to 10 stocks have actually led this entire move to the upside. This is typical of longer-term tops in the market. It happened in late 2021 as the NASDAQ put in its final high, the all-time high, and as the S&P was making its final high in early 2022. Put-to-call ratio rejected this prior area of support. Now it's an area of resistance. We need to see the put-to-call ratio come all the way back down below the 0.8 level, then cross back up for a confirmation of a sell signal and a major top in the market, similar to these prior tops. Fear and greed actually bottomed recently, and it's been moving sideways. Again, the market has had a tendency to top around the 75 reading, not quite there yet. So we're expecting more upside here as more and more short squeezes take place. All of those bearish bets made by retail traders getting squeezed and then finally putting in the top and then finally moving back down. So market momentum moving sideways. Breadth is declining as the market is trying to push higher, led by tech. Breadth continues to decline, put to call ratio continues to decline, market volatility trying to find a bottom here and will likely continue to weaken as the market puts the top for May. Safe haven demand moving sideways. Junk bond demand still at the greed reading. Still, if we take a look at seasonality for May, usually guys, we got a lot of negativity in May. We haven't seen that yet. We've seen a timid market that hasn't really followed seasonality. So May has been a very tricky month to trade. And it's mostly because we had a really weak breadth rally. A rally only led by a handful of stocks. And again, this usually happens when the market is trying to put in a major top. Tomorrow we'll have PPI and Friday we'll have the Michigan Consumer Sentiment Index. So keep an eye out. We have two catalysts both coming this week. I hope you found this video helpful, guys. If you have, I would really appreciate it if you slap that like button on your way out. If you watched till the end and you did not enjoy the video, I do thank you for your time and your attention. That's all I have for you today, guys. Thank you so much for watching and I'll catch you in the next one. Bye-bye.
Oh, wow.